From the regulating body that's proposing the new crackdown to its potential impact on the crypto market as a whole, the UK is about to regulate crypto, and here's what it means for traders. Up until this point, crypto's been loosely regulated at best and completely unregulated at worst. Unlike other financial products, such as savings, pensions, and mortgages, in the UK, investors and firms benefit from the Financial Services Compensation Scheme, or FSCS, for the protection of their real or fiat currency. The FSCS means that if a company or a UK citizen has savings or investments which collapse, up to 85,000 euros of their money will be protected. UK citizens can complain to the Financial Ombudsman Service if they're unhappy about a regulated service or product, or if they think they've been misled. So UK investors are offered some protection when it comes to conventional investing, but when it comes to crypto, there's currently no such protection in place. If an individual invests in a cryptocurrency or token that subsequently closes, they may never see their money again, as many investors in FTX found out the hard way. It also means that there's no protection for consumers if they're scammed by fake cryptocurrencies or targeted by fraudsters using unregulated crypto tokens. I'm sure we've all heard of the now common phrase, pump and dump, where an essentially worthless coin is hyped up and artificially inflated, only for someone to get very rich, and whoever's left holding the hot potato gets seriously burned. As it stands, founders of digital currencies don't have any responsibilities that executives at regulated firms have, such as treating customers fairly or making terms and prices clear. Most cryptocurrency founders are located around the world outside of the UK, which makes it even harder to draw up a plan to regulate such an international industry. Currently, all UK-based crypto firms must comply with the Money Laundering Regulations 2019, but all future crypto regulation in the UK would be overseen by the Financial Conduct Authority, or FCA. Since cryptocurrency is classified as a financial service, there are only around 40 FCA-registered crypto providers, with the most well-known brands being Bitpanda, Gemini, and Kraken. However, many of the world's largest exchanges operate outside of the UK and aren't obliged to comply with the MLRs. But all of that might change if the new proposed regulations come into law. First, what is the Financial Conduct Authority and what exactly do they do? According to their website, the FCA is a UK financial regulatory body, which operates independently of the UK government and is financed by charging fees to members of the financial industry. They list their objectives as protecting consumers, protecting market integrity, and promoting competition, which all sound like reasonable goals if you ask me. Financial service providers in the UK must be authorized by the FCA, remain under their supervision once authorized, and can have penalties levied against them if they fail to meet FCA standards. But the new regulations aren't actually being proposed by the FCA themselves. They'll simply oversee them once they pass into law. The UK government itself is proposing the new regulations. More specifically, Her Majesty's Treasury has submitted a consultation containing its new suggested regulations, but they'll look slightly different when they're passed into law. So what does this consultation actually say? And what does it mean for crypto markets in the UK and beyond? The consultation is titled Future Financial Services Regulatory Regime for Crypto Assets. It's a mouthful, I know. But anyway, the paper begins with the authors reminding us that the UK seeks to become a global crypto hub. The nation's already a world-leading international financial center and the leading net exporter of financial services across the world, so it's no surprise that they want to get a piece of the crypto market. If they succeed in their mission, they'll lead the rest of the world in their approach to cryptocurrency, which is why their new regulations could affect crypto markets worldwide. The authors go on to warn that with the rewards of crypto comes risks, citing the crash of FTX, and that the regulations outlined in the document are designed to mitigate those risks and maximize rewards. The first part of the paper covers existing regulations, noting that most crypto activity simply isn't regulated as we mentioned before, and that international bodies such as the FSB, BIS, and FATF, which are independent and unelected, are currently setting global standards for crypto regulation. The document notes that its regulations don't pertain to digital ledger currencies, something like the digital pound, and is only aimed at cryptocurrencies. It lists the 4 policy objectives as encouraging crypto innovation, educating consumers on the potential risk of crypto investment, protecting UK financial stability and protecting UK market integrity. The second part of the consultation defines cryptocurrency, acknowledges that there doesn't seem to be a worldwide definition for it, and it's worth noting that NFTs aren't included. The third part deals with pre-existing UK regulations that will apply to crypto, including KYC and AML, which focuses on customer identity verification. The fourth part deals with the actual regulations being placed on crypto activities, and says any regulation should be tailored to risk, acknowledging that it's hard to tell when transactions are taking place within the UK's borders, so some amount of nuance is going to be required. The regulations only apply to crypto activity occurring in the UK, or to a UK consumer. The activity listed is issuance, payment, and exchange. It's worth noting that the banning of algorithmic stablecoins was not proposed because it was in the EU. But the consultation document suggests that it may come later, with further regulations that pertain to cryptocurrency itself. The fifth part of the consultation covers new cryptocurrencies, which means any coin or token listed on an exchange and available for trading. It stipulates that investors need to be given accurate information, must be compensated if they were misled, and all fraudulent crypto offerings are banned. Crypto exchanges will have to perform extensive background checks on any new coin they list and provide a detailed description of their coins to the consumer. The sixth part of the consultation covers the regulation of crypto exchanges themselves and has been a hot topic in the wake of the collapse of FTX, which was at one point valued over $25 billion. Its current value today? $0. The consultation lays out that crypto exchanges have to be more resilient and liquid, must operate with more transparent terms, and provide accurate on- and off-chain crypto data. Followed by this is a lengthy list of requirements that crypto exchanges must adhere to. The seventh part deals with the regulation of other crypto intermediaries, while the eighth covers crypto custodians. The ninth section covers general market abuse, or as some might call, market manipulation, such as the pump and dumps that I mentioned before, or wash trading. The authors note that these things are pretty unique to crypto, and says a separate subset of regulations will have to be devised to deal with that kind of manipulation. It also notes that since crypto markets are global regulations will have to be implemented to prevent market manipulation from foreign entities. The last few sections deal with the borrowing and lending of crypto, and it also asks for additional feedback on activities such as mining and staking. Now, the question on everyone's mind is, how will all of this affect the crypto market and traders? Well, the effects of the regulations on crypto depend on how far it goes. If the form these regulations take when passed into law is too restrictive for UK crypto firms, they might opt to take their business elsewhere, as many did when FCA registration was first introduced. However, the regulations could also have a positive long-term effect, because a more stable market could boost confidence in the sector, as exchanges follow set standards and are required to check coins before listing them. This could mean more people end up investing in cryptocurrency. But according to the consultation documents, that depends on whether or not traders are interested in complying with the new regulations. If you live in the UK, you'll likely no longer be able to trade on an unregulated platform, which many traders like to do. If these regs pass into law, unregulated platforms outside the UK will be unable to provide services or advertise to UK consumers. And considering that 5 to 10% of the UK population holds crypto, that could be a big market to get cut off from. Traders looking to trade using UK firms may have more hoops to jump through in order to ensure that they're following the new regulations outlined. This might drive them to take their business elsewhere to a country with fewer regulations. So there you have it, folks. From its potential impact on the crypto market as a whole, to the regulating body that's proposing the new crackdown, the UK is about to regulate crypto, and that's what it means for traders.